Hello everyone, welcome back to Bullsmart Academy. In this week's series on understanding different mutual funds, we will delve into liquid funds. Many investors tend to believe that mutual funds cater exclusively to long-term investors. However, today we are dispelling this myth with liquid funds. Additionally, we'll explore whether liquid funds perform as well as other popular liquid investments such as banks and FDs, and if they can serve as a viable alternative. To uncover these answers, stay tuned. When it comes to selecting mutual funds, preferences may vary among investors due to differing goals. Some prioritize steady income while others possess a higher risk appetite. But what about investors who already have investments aligned with their long-term goals and seek alternatives for short-term liquid investments? Enter liquid funds. As the name implies, liquid funds emphasize liquidity and aim to yield returns in the short term. They primarily invest in debt instruments like short-term treasury bills, commercial papers, and highly liquid government securities. With their solid security and short-term maturity duration, sometimes as little as 91 days, they facilitate liquidity. Since the investment manager's tenure typically spans around 91 days, the impact of fluctuating interest rates is less likely. Now that you grasp what liquid fund entails, you might wonder why one should consider them amidst various short-term investment options available, such as short-term FDs or even regular savings account. Let's compare them across 4 parameters: risk and return, liquidity, and taxation. Firstly, concerning risk and return, bank FDs pose extremely low risk, while liquid funds, though considered secure due to their invested securities, can still be influenced by market conditions and volatility. Regarding returns, bank savings accounts presently offer interest rates of around 2.5%, while short-term FDs with tenures ranging from 1 week to 6 months offer interest rates between 3% and 5%. Liquid fund returns vary based on the duration, ranging from 3 to 6% over 6 months, and have shown returns between 6 to 7% in 2023. Moving on to liquidity, FDs come with a cost for liquidity. They have fixed maturity periods and breaking them entails penalties. On the contrary, liquid funds have no exit load or penalty provided you hold your investments for at least 6 days. If you redeem your investments within this period, exit loads apply. Regarding taxation, the interest earned from FDs gets added to the annual income and is taxed based on the individual's applicable slab rate. Liquid funds are also taxed at the applicable slab rate, but only if held for less than 3 years, which is generally the case for short-term investments. So, are liquid funds the optimal choice for you? Before deciding, note that the liquid funds charge an expense ratio with a category average of 0.16%. Additionally, heed the old saying, don't put all your eggs in one basket. You might not need to choose between savings or liquid funds outright. It's advisable to use your savings account for immediate requirements, liquid funds for idle cash that may be needed for liquidity, and FDs for short-term investments with a fixed tenure. Let us know in the comments which short-term investment do you prefer and your thoughts on liquid funds. Happy investing until next time.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.